Today, we're looking at the S&P 500 setup as we start October. As you know, we're coming off the first 2-month losing streak since August, September 2022. So 2 years in a row. The last 3-month losing streak happened in January through March 2020. We all remember that. So the worst kept secret, of course, is that the S&P has adhered to the typical subpar seasonality path again over the last 2 months. However, monthly declines greater than 1% for both August and September, like we just had, have been pretty rare over the years. In fact, going all the way back to 1950, it's only happened 13 prior times before 2023. And so here's a table from Ryan Dietrich of Carson Group, as you know, does great work, showing that the S&P has been actually higher 70% of the time in October and 92% of the time for the fourth quarter, after losses of at least 1% for both August and September. The average moves, as you can see here, pretty substantial, 4.5% on the upside for October, 7.5% or 7% for the fourth quarter. Now, even more recently, we see how well it's done. In the 4 occasions since 2000, S&P has been higher 4 out of 4 times, both in October and in the fourth quarter. So we have positive stats, positive seasonality as well to lean on. And from a support perspective, also helpful as well. We can see here that there is a confluence of support in many different capacities. Here we have the uptrend line, of course, extending from the October low, the 38.2 retracement point of the entire rally here. We have former highs from last February and from April as well. There's also the 200-day moving average there, and of course, round number significance at 4,200. So all very good, all reasons why the S&P was able to bounce over the last few days. Now, of course, the issue is that even though it's been able to, again, move higher a little bit, we haven't had that really snapback move, haven't had a 1% advance since August especially. And so because of that, this big bearish pattern still remains in play, as does the 4,050 downside target right now. So the question is, of course, is how likely is it that we actually achieve this target? There's a number of things to look at. One thing we can actually point to is that the equal weight S&P 500 ETF is doing much worse so far. And that was especially clear yesterday. And here's a chart. So S&P equal weight ETF was down 1.1% yesterday. And as you recall, the S&P was unchanged. That's a very big difference, big price discrepancy. And clearly, it's unraveled much more aggressively from a pattern perspective versus the S&P since then as well. So broke down and really hasn't had too much of a reason to rally. And we can see that it's more than halfway to its own downside target near 136 down there. And so at its lows yesterday, its current drawdown got to almost 11% from the highs, right? So in correction territory already versus just about 8% for the S&P. Now, this isn't too surprising because we saw the same type of underperformance for the RSP versus the S&P back in February or March. We can see that it was down almost 13% back then. S&P was down only 9%. But it does show that in terms of when things unravel, the smaller names actually do worse, which of course means that bigger names have helped it. And we can see that on a year-to-date basis now, yesterday's action put the RSP actually in negative territory for the year, where the S&P is still almost up 12%. So very distinct underperformance here. And so, of course, that just means that the bigger names continue to do better, even if the S&P is moving lower. And so yesterday was just an extreme example of that, where XLK was, technology ETF was up over 1% and literally was responsible for keeping the S&P above water. So it was up a 4th straight day yesterday, and now up 6 out of 7 trading sessions. And the bounce that has been better than most has taken the ETF back above its own breakdown zone here, which of course is very important to continue to hold going forward. And those are the main things we'll be looking for over the short term. You check out these other videos we have here, especially this one in seasonality that we put out a few weeks ago. I talked about September, but also what it could do toward the end of the year.